Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Ryan McCormack, Core and Factor Equity Strategist at at Invesco, for a weekly performance in the triple Qs in the Nasdaq-100, as well as we'll talk about some forward-looking price changes that are expected. Ryan, it's great to see you as always. Welcome back to TradeTalks, and let's talk about the performance that you've seen in the Qs over the past week. Certainly giving back the gains that were acquired over the year, and there's really no shortage of news for it not to be under some selling pressure.
No, I would agree. And you know, when the dust settled over the past week, we had QQQM and QQQ down 7 basis points versus the S&P 500 up 36 basis points and S&P 500 value up 33 basis points. But really, Friday was the challenging session with QQQM and QQQ losing about 1.25%. You know, we saw a lot of worries about geopolitical risks and further pressure on prices weighing on Qs throughout the session. We saw oil prices jump on Friday with Brent and WTI both advancing by nearly 6% on concerns of escalation in the Middle East. And on Thursday, the day before, the U.S. imposed sanctions on tanker owners that were carrying Russian oil priced above $60, which is the G7 cap. Over the course of the week, there's been calls for the U.S. to sanction Iran and its oil exports on any role in the conflict going on in the Middle East. And even today, we see oil up over 2%. And any further restriction could continue to put upward pressure on prices. So, you know, we sort of saw that pricing pressure starting last week and you know, continuing even into this week.
And Ryan, let's take a look at the sectors that relatively led the way in terms of performance. Was it broad-based underperformance, or all 11 sectors impacted?
Yeah, well, you know, I mean, from when we're looking from a GICS sector perspective, we had 4 of the 10 sectors within QQQ finishing in positive territory. That's compared to 8 of the 11 sectors in SPY, which is the S&P 500 proxy, were up for the week. Really, we saw financials and information technology being the biggest detractors to relative performance against SPY. Financials had moved higher by 1.25% in the S&P 500, while QQQ, it's only financial, is PayPal, which is not classified as a financial by ICB, but it was lower by nearly 1%. And then we saw tech stocks trading slightly lower for the week, but QQQ's 21 percentage point overweight to the sector versus SPY hurt relative performance. And then, of course, SPY's overweight to energy hurt QQQ relative performance, as the sector was the best performing in both SPY and QQQ with crude oil's advance.
Finally, Ryan, I want to take a look at the University of Michigan expected change in prices during the next year, which tends to be an accurate indicator, how this is going to impact the economy.
Yeah, and I think it sort of carries the same worries when it comes to upward pressure on prices. So Thursday we saw headline CPI for September come in stronger than anticipated. So year over year at 3.7%, that matched August's reading, and 0.4% month over month, slowing a little bit from August's 0.6%, but hotter than the 0.3% forecast. Then Friday, we got some data on consumer expectations for prices. So according to the University of Michigan, the preliminary October reading for the one-year expected change in prices rose to 3.8%. That's up from 3.2% in September and the 3.2% forecast. So it's the highest expectation that we've seen since May. And then similarly, the 5 to 10 year inflation expectation ticked up a little bit in September, or from September's 2.8% to 3.0%. So you kind of saw this worry on inflation. Markets are interested about the implications for further Fed activity. And from a Fed funds futures perspective, the possibility for another rate hike before year end, it's increased. Last week, there was about a 30% probability of a rate hike before year end. And today, that probability, as of about 2 hours ago, had climbed to over 43%.
Yeah, well, I mean, it is a challenge for them to engineer a soft landing when you have unemployment at 3.8%. Virtually everyone who wants to work is employed, and the consumer spending money. I mean, that's the backdrop of our economy, nearly 70% of GDP. So if everyone's working and there's no catalyst to put one sector over the edge, and you start to see, a mass exodus of jobs there, nearly everyone's working.
Yeah, I mean, it's a sticky dual mandate that the Fed has, right? It's maximum sustainable employment, which for by and large we have been at maximum sustainable employment, and then keeping a cap on prices, or at least a normalization of prices, and that's been the far more stickier portion of the equation, and one that seems to change with each trading session.
It certainly does, Ryan. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.